Hi guys, welcome back to another week of Mortgage Matters in Minutes. Again, I'm your host, Brent Rasmussen, here today, and thanks to Jonathan last week for subbing in while I was in CE education instructing in Des Moines, Iowa. So that concurs our classes in Iowa. We're working on moving to Omaha here this week and then down to Missouri the next week and following. So today's topic is financial principles don't change just because markets change. And this topic today is brought up because we're getting, and we've always had, as markets change, individuals that are trying to time markets perfectly. And while everybody wants to time markets perfectly, it's never, ever, ever going to go that way for you. And maybe it's just luck that you happen to time things absolutely perfectly. For example, I'm a mortgage professional. Obviously, on my own house, I carry a mortgage. And do I have the lowest rate that ever was? No, because at some point in time, we have to act when rates are low and pick a time. And sometimes it's the perfect day of the last 50 years, and it might not be the perfect day, but as long as the financial principles make sense, my interest rate is still very, very low. So today we're going to talk about some basic financial principles. And while those financial principles have always been around, they don't change just because the stock market is doing well or doing bad. Or those financial principles don't change just because the housing market is doing good or is doing bad. Or if oil prices are up or if oil prices are down. There's tons of different kinds of markets that we can chat about. And there's lots and lots of different terminologies and discussions that we can have. But all of these financial principles that we're generally going to speak about today are going to make sense whether we're doing very good in our market or we're not. So the first basic financial principle is pay yourself first. Save money for your retirement, your emergency fund first, and spend less than you make. Obviously, that is simple in theory, is to start putting money away as a budgeted item, just like your car payment, just like your credit card, as opposed to putting $100 towards all of your expenses first. Put money aside first for your investments, your savings, your retirement. And then budget your money. Create a budget and follow it. And stay true to that budget. Just because something comes out that you want, or the holidays are here and you want to buy extra Christmas presents, that might not make the most amount of sense for you and your financial situation. Another basic financial principle is high return, high risk. Low return, low risk. Okay, so if we're wanting a 20-30% return on our money, obviously we have to get very, very aggressive in what we're investing in. Hence why if you go to the casino, it's a very high risk, but you might make a high rate of return. But other people might invest in low return bonds, which is very low risk, but they get a very low rate of return. The biggest one that people are always want to speak about is buy high, sell low. Buy high, sell low. Obviously, everyone wants to perfectly time that, or buy low, sell high. Everybody wants to time that. It makes perfect sense. Obviously, if we can buy a good when it's the most expensive, buy a good when it's the least expensive and sell it when it's the most expensive, obviously that's the best time. But can every person on the planet time that? No. Even our geniuses of the world that handle financial planning, and the Warren Buffetts and these people like this, not everyone's going to be able to time things perfectly. Diversification and having investments in multiple categories is going to allow that. And housing is a diversification that technically happens in your financial plan, that you can sell that asset for something at some period of time if you needed it. Another basic financial perspective or financial principle is plan for the unexpected. There's lots of things that'll come up in our life, and I hate to see people get sick, lose their job, become injured, permanently disabled. Unfortunately, those things are going to happen, and making a game plan to have either insurance or a savings plan for when those are set up is another basic financial principle. Compounding interest is the eighth wonder of the world. Albert Einstein came up with this, saying if you don't understand it and you don't actually use it to your benefit, you actually pay it. You lose if you're not involved in dealing with compounding interest. And all compounding interest is the sooner you get involved in starting a savings plan and investing plan, the more quickly your money is going to turn over and give you a higher number at the end. It doesn't need to be super complicated. People want to use these big words, and I'm trying to always, as an education, bring it it down to a 3rd to 5th grade level for anyone to understand that starting with any kind of investment, while you're going to have ups and downs, over time it's going to always, and we've always seen nearly every good stock market, home prices, everything go up. It's going to see some downs along the way, but at the end, we're going to be up. My biggest, conversation I have with clients is doing whatever you invest in, do it early, whether it's saving for retirement, whether it's purchasing your first home. And I know a lot of people right now are discussing, well, rates are high, home prices are high. But at some point in time, if you purchase today, you're going to have that asset when other people aren't going to have that asset a year or 2 or 3 years down the road. And while maybe you pay over, maybe you don't, maybe you pay under what the market's going to be in 2 or 3 years, starting now will give you a better rate of return over 5 or 10 years. It always has, it always will be. Trying to time the markets perfectly is never an exact science. Even the professionals of the world have struggles with timing things of when to buy and when to sell. Markets fluctuate up and down. They always have, they always will. And have we seen every type of up and down market? Maybe, maybe not. But we can see through history what we need to do in those markets. Right now, a lot of people are saying, let's not buy in the housing. Let's wait for things to come down. I would say people also are saying in the stock market, well, I'm not going to buy because stock market is down. That's actually the opposite, right? The stock market is down. People want to buy. Do they like to see their portfolios going down 20, 30, 40%? No one does, right? But at some point in time, we don't stop investing and we don't stop buying goods that we need as assets just because the market is lower. Okay, there's a lot of different rate of returns financial advisors, CFPs can go through in explaining all this, but dollar cost averaging is one of those items that if you buy stock every day for 365 days or for 10 years, you're going to buy on certain low days, you're going to buy on certain high days, but it's going to average out to a normal number throughout that time frame. So what I'm here to kind of tell you today is all of these financial principles that we've talked about all still stay true, no matter if the market is going up, the market's going down, if it's flat. Really all I'm here to tell you to do today is if you haven't started a plan, start a plan. If you have a plan that needs to be adjusted, adjust your plan. But don't sit on the sideline and say, I'm not going to do anything and I'm going to wait for something to change in order for your financial goals to come true. And people ask me all kinds of financial questions. And some of it we're licensed to answer. Some of it I can answer, but I'm not an expert in that. But at some point in time, not every person's financial plan is the same. Some people want to work till they're 80. Some people want to work till they're 50. Some people want a very lavish retirement and want to travel. Some people don't. So every person's plan and what they want to do is a little bit different. But when we look at basic financial principles, those don't deviate. Those don't change. We don't say, well, because housing market is not running perfect, we're going to choose to not agree that we choose to agree that housing is not a good investment. And I would completely disagree with that. And I see, unfortunately, some younger generations, some older generations, some middle of the line generations say, well, I'm going to wait this out and see what happens. And of course, that's their decision on whatever it may be, but I can definitely have seen that waiting out period for 10, 15, 20 years, and waiting it out doesn't really change the decision, which is the answer that usually comes to me is I wish I would have did something 3 years ago, 5 years ago, 10 years ago. I wish I would have bought when the home prices were this. I wish I would have bought when the home prices were that. No matter what the interest rate is, and I've heard a lot of the stories that I bought my first house when rates were at this or rates were at that. And still, the financial principles of lending state that we must calculate a debt-to-income ratio, meaning we can't give you a loan much higher than what you can actually afford to pay. So regardless of your rates at 300% or 6%, we still have to do the math to make sure you qualify by federal government and federal rules. So again, our basics of this video today here is just to remind you that understanding the basics of financial principles is what you want. Trying to time things, trying to get involved in crypto and being the perfect timing market is never going to win in the long run. Day traders aren't going to win in the long run. But having a solid financial plan, having diversification of where your money is, but also having housing involved in that is a very important part of your financial piece. It always has been, it always will be. There's tons of statistics out there that show people that own housing have significantly higher net worth than people that don't. So not choosing to buy something today because rates are at 7%, Maybe they'll be at 12% next month or next year. I don't know the answer to that necessarily. I don't believe that's going to happen, but could it possibly happen? Sure. But all I'm saying today is getting your financial strategy in order and making an adjustment to that. And if that includes you as a first-time home buyer or you as a move-up buyer purchasing a house, I would tell you it's still a good time to purchase a home. There's less people finally out in the market looking for homes. Home prices are getting corrections and they're coming down in price. Sellers are helping people with closing costs and prepaids. So even though other people are telling you rates are high and the market might not be great, don't believe everything they're saying. They're not in these financial markets and they're not understanding financial plans every day. Am I ever going to advise a client to overpay for something that they can't afford? Never. That's not the idea. The idea is, though, to look at your budget, look at what you're spending your money on, and if we can get that housing payment in line with what you can afford, then let's do it. Let's pull the trigger. Whether that's a $100,000 house, a $200,000 house, a $500,000 house, whatever that number is for you, let's get it started now so in 10, 20, 30 years down the road, you understand that, hey, I'm glad I did this investment or this decision because it gave me this rate of return. I can't tell you how many people that pass away. I'm sure their families are very thankful that they have life insurance. Some people don't carry life insurance, but those are the decisions that you want to think about what's best for long term in your financial plan. So I hope you learned a little bit today. Obviously, as you can see, when it comes to finances, I do get very emotional. I want people to make the right decision, the best decision. And here at Mortgage Specialist, that's what we want to give everyone as advice, is to do what's correct and right for you. And let us talk to you about what makes sense. If it doesn't make sense for you today for some reason, we understand. Let's not do something. But if it does, let's pull the trigger and let's get out, have you search for homes and see a price that fits into your range. So again, here at Mortgage Specialist, we love education. We love to give you the correct answer. You can phone call us at 402-991-5153, or you can always check out all of our blogs at mtg-specialists.com, and we're here to help. We'll talk to you very soon. See you here next week, same time, same place at 3 p.m. for Mortgage Matters in Minutes. Have a great one. Mortgage Specialists. Driven, trusted, reliable.